So the question before the house is, if we have all these behavioral biases that we've talked about the last 3 weeks, how do we manage that so we can make better decisions about life and money? Well, that, my friend, is what we're going to talk about this week on the Retirement Answer Man Show as we end this month-long series on behavioral management, behavioral finance. So welcome to the show. My name is Roger Whitney, by the way. I am your host, and this is the show dedicated to helping you not just survive retirement. We are here to help you rock retirement by being very intentional about the actions you take. We believe you can rock retirement. And so today we're going to try to talk about some things you can do to make better decisions and manage yourself. And then we're going to have in our extra segment, our head coach from the Rock Retirement Club. That's our private club for people transitioning and living in retirement, where it's a safe place so we can get world-class education and chat with each other. You can check that out at rockretirementclub.com. We're going to bring out our head retirement coach, BW, to talk a little bit about decision-making and identity. But before we do any of that, let's define another term when it comes to behavioral finance.
Huh? What does that mean?
Heuristic. We're going to define that. But did you realize that your brain takes up about 2% of the body weight of an adult, but it consumes 20% of the energy produced by the body? That's a big amount, large amount. And so what we do psychologically is something called heuristic. And psychology today defines it as a mental shortcut that allows an individual to make a decision past judgment or solve a problem quickly with minimal mental effort, a heuristic. And we have a lot of those in all areas of life. Dr. Daniel Crosby, the preeminent psychologist on behavioral finance, in my opinion, joined the Rock Retirement Club for an hour private session with all our members to talk about how we make decisions and how we can manage all the cognitive biases that we do, because that's what we do in the club, is try to go deeper on this stuff. And he called it bumper sticker thinking, or thinking in bumper stickers. So we have a lot of heuristics that we use, say, in retirement planning. The 4% rule is one. It's a bumper sticker. It works. It's very simple. And when we're confused, it's easy to latch onto. Another one might be 100 minus your age is the percentage you should have in stocks. If you're 60 years old, you have 40% in stocks. And as you get older, you decrease the stock allocation. That's a bumper sticker thinking. That's a heuristic. And they permeate all of parts of our life because our brain uses so much energy. It's always trying to conserve and look for shortcuts because it's got a lot of stuff to do. I mean, for me, I have to walk, talk, and maybe chew gum at the same time. So I got to create shortcuts. So that's what a heuristic is. So with that, let's go into our main segment, talk about how to make better decisions, and then we'll get on with BW in the coaching section. I read the other day in the Wall Street Journal, it was June 7th, that since the downturn in 2020, money market balances, savings accounts, cash, has risen by over $1.2 trillion. That's basically institutions, businesses, individual investors selling bonds and stocks and moving it to cash. Now, obviously, there are lots of reasons why people do that. But we see this kind of reactionary thing happen over and over again during downturns, just like we see the opposite happen, money flooding in when we feel good. And when it comes to how do we make better decisions so we can be intentional, you can be intentional to rock retirement. This is really important because you're listening to a geeky show like this because you're probably thinking about retirement. And in retirement planning and in financial planning in general, in financial theory, there's this optimization of using our money to optimize returns or the potential for returns. In investment management, like we talked about before, we have specific risks, which are the risk of owning an individual company or a sector or an asset. But financial theory says you can diversify and get rid of that risk by owning lots of different things. And then you're left with market risk of owning stocks or bonds or real estate. And you can't really get rid of market risk. And then modern portfolio says that if you have a given level of risk tolerance, you can optimize your potential wealth or returns by buying a particular portfolio. This is how financial planning theory and investment management works. Optimizing based off of a spreadsheet or algorithm that crunches the numbers. But I think what we're missing most in all of financial planning, but especially in retirement planning, is how do we manage the most significant risk to your life and your ability to create a great life that you have? It's not specific risk. It's not market risk. It's behavioral risk, causing a behavioral tick of a heuristic shortcut or a cognitive bias to manifest its head when we're vulnerable to it because of feeling that we're not enough or feeling that we're not in control or fear, greed, and all that other stuff. During our private session with Dr. Crosby in the Rock Retirement Club, we talked about this, how if you don't get the behavioral part right and set yourself up for success, it doesn't matter what the spreadsheets say. And his comment was the portfolio, and I would insert strategy that optimizes your wealth or your life, is the one that you can actually live with, that you can actually execute on. Meaning that you're not buying when you're greedy and selling when you're worried based on the whims of the world. Another article, I don't know if it was a Wall Street Journal, that talked about the percentage of people over 60 or 70 that went to cash from stocks. And if I recall, it was something like 30%. Well, if that's the case, and I think Dr. Crosby said this, it didn't matter whether that was the optimal portfolio based on whatever model or theory there was, because it wasn't optimal because they couldn't stick with it. And in retirement, in this harvest period of life, we got to make sure we handle the behavioral aspects of it more than anything else. So what I want to talk about are some just general tips to help you manage the behavioral risk, which is the biggest risk you have to not rocking retirement and risk you have in general decision-making. And then I want to go to a little bit more formal structure to think through this. So it's just some general tips. The whole idea of diversification, of owning everything rather than trying to pick the individual winners or losers, is an act of humility. I don't know. And that act of humility in buying markets rather than trying to pick winners and losers is a way of diversification, is expression of humility. Actually, you can do in other parts of your life. When you're retirement planning, when you're thinking about your spending and inflation and the whims of personal change in your life, there's a lot of, I don't know. And so I think one tip is to approach this in a very humble aspect and not trying to act like you do know. And sometimes we try to overcompensate for not knowing or feeling in control by just saying, okay, I got to figure it out. I got control, and just overcompensating. And for me, I think the way that you can accomplish that is to put a premium on optionality, having the ability to make changes with not a lot of friction because of all of the things that you don't know. Now, there's some positives to optionality, meaning that you can be nimble, right, as life unfolds. But the downsides of having optionality is you can make changes easy. So if you have a cognitive bias that raises its head, you could react. There's a reason there's a one-click purchase on Amazon, right? They've eliminated all the friction so you can buy things in an instant. That's taking advantage of some cognitive biases, taking away that friction. So there's a downside to that as well. Another tip I would suggest is don't white knuckle it. If the portfolio management software says that you need to be allocated in such a way that you have white knuckles and you can't sleep because you're so worried during volatile times, don't white knuckle it. Think of like Steven Seagal in jiu-jitsu. We need to use our cognitive biases and redirect the energy towards something productive. Just like Steven Seagal did in the movies. The guy would come running at him with full force, and rather than meet him head on, he would redirect the energy and use it against the enemy. So if you have a cognitive bias, whether it's for status quo bias, confirmation bias, information bias, figure out ways to set up systems so you can redirect those natural tendencies and make them work to your advantage. Another tip, and this is the fundamental premise of the Rock Retirement Club, is consistently receive feedback from others you respect that have a diverse point of view. Because what you don't want to do when you're making decisions is just be in an echo chamber. And we see that more than ever in today's world. We see echo chambers. We only listen to people that we agree with. And so you have to be careful to cultivate who you allow to speak into your life. It's important to have diverse opinions to give you outside context and perspective. And it's important that it's all done in a very respectful way. That's what the club is. It's meant to be a safe place to share different ideas because we're all humble and trying to figure this all out together. So you want to make sure you have that in your life so you can check yourself. Check yourself. by having diverse points of view that you have enough respect for, and it's done in a respectful way that you will listen. Another tip I would suggest is, in fact, the more adamant or convicted you are about a course of action, I'm going to buy that lake house, or I'm going to go all the cash, or I'm going to go all in, pause and force yourself to write out the opposite case, all the reasons against the decision that you're so convicted about. It's hard to do. It's one thing I didn't realize at the time, but I'm most thankful for from high school and college and being in debate. Because in debate, you would have a resolution that would sort of go throughout the season. There are lots of themes on the resolution. And then each team would either be the affirmative or the negative, arguing for the resolution in some way or against it. And usually as a debater, you were, depending on the situation, taking opposite sides of the issue, depending on what debate you were in. And so it forced you to see from the other perspective and to actually be able to craft persuasive arguments for something you potentially didn't agree with personally, but that was the exercise. The argument wasn't to be able to be persuasive even if you don't agree. The argument, the point of the exercise was to help you be able to see an issue more fully. So if you're looking at a decision, it's a big decision. Maybe it's buying a lake house. Sit down and write out either in a session or in a few sessions, all the reasons you shouldn't. What are the persuasive reasons why you shouldn't do this? And that will give you some more perspective. Now, the last tip, I think, is the most important. And that is this concept of personal benchmarking. So generally when we're benchmarking, so benchmarking is basically comparing one thing to a standard. Investment portfolios, a lot of people will compare their equities to the S&P 500. The S&P 500 is the benchmark of which we compare everything against. Well, a personal benchmark does this whole Steven Seagal jiu-jitsu thing in helping you take advantage of something that humans do very naturally, which is mental accounting. And this goes to the envelope system of if you have money that you mentally have allocated to your vacation, you treat that money differently than the money that you've allocated in your head or in an account to go to Vegas or to do long-term investing or to buy gifts for your kids, the old envelope method. So when you do that mental accounting, and I bet you do that subconsciously, if you look at your bank account and you look at your savings account, mentally, you're probably, okay, that portion is going to be for the trip. That portion is going to be for that gift. That portion is, I'm going to have to invest that at some point. We do this mental accounting almost subconsciously. So what a personal benchmark does is take your view from comparing yourself to the Joneses or the markets or the economy and has you look inward and say, in case of retirement, I want to retire. I need money to spend for the next 2 years. And then I need money to spend for the next 3 years after that. And then I'll need money longer term and then even longer term. In creating a personal benchmark that is important to you. And in retirement context, that personal benchmark would be, I've mapped out these cash flows that represent the experiences I want to create in this, my one iteration of life in retirement. And I've taken my assets and I've divided them mentally and actually physically in different accounts of this is my 2 years cash reserve. This is my year 3 through 5 money. This is my 5-year plus money. This is my 10-year plus money. And when you do that, and I actually like to do that where you have separate accounts that are labeled as such, you create a personal benchmark. And behavioral finance says that allows us to look inward at what matters most to us rather than outward at the S&P 500 or the markets or the economy or whatever. And we become much more comfortable with optimizing our life rather than feeling like, wow, all this money in our cash account is not optimal for our long-term wealth, even though it's optimal for our life. So that's one, I think, a really good structure. For us, it's the pie cake, creating those different layers of allocations based on the life that we've mapped out that we wanted to create. So those are some general tips. So let me just tell you how I try to manage behavioral risk with clients. But if I'm honest, this is how I try to manage behavioral risk for myself as well. And I'm not even talking about with my own money. I'm talking about when I'm counseling clients, because here's the problem. If a client calls up and they're scared and they want to sell and they're worried about the market and they're freaked out, as an advisor, being the human that I am, I prove myself that fact every day. I want to please the client. I don't want them to be afraid. When they're afraid, I'm afraid. I'm worried. I'm not doing a good job. I want to relieve that stress. And so it's very easy for me as an advisor to try to take a very quick shortcut to relieve that stress. Okay, let's go to cash. Okay, here's a product that protects us on the downside, but maybe gives us some upside. This might help you, and mentally it might fix the initial need of the client, but it's giving in to a cognitive bias and a behavioral tick that's not really in their long-term best interest. So for me, I have as much risk as the client, not quite as much for them, but a lot of risk as well of making sure I'm helping them make good decisions, not just me. So here's the process that I use. And we've talked about it on the show many times. And if you want a more formal article about the process, and we can put a link to the show notes in 6 Shot Saturday, which is our email list. You can find that at rogerwhitney.com. You can sign up for that. We just send out an email every Saturday morning with links of important things or things that we talk about on the show. And you can Google KITCES, KITCES, and then Agile. And I think it's the first article in the Google search is an article that I wrote that outlines Agile financial planning. It's really meant for advisors, and it's going to become a book that I'm working on, but it is a framework that I use to help manage decision-making. And it basically goes around this. It's not going to sound like rocket science, but the beauty is in the execution, I think. Number one, the process. Everything has to go process, strategy, tactics. And we get that totally backwards. And if we can stick with process, strategy, tactics, it will, one, slow us down and center us. And so if you can stick with this, it will slow you down and center you. And always go back to, what do I want my life to look like? How do I position? And that's the kind of life you want to live. Those vacations with your family, the trips with your spouse, the hobbies, the workshop that you want to create in the backyard, all the things you want to spend money on. What's important to your life in retirement? How do we position our resources to confidently create that life? That's matching up your resources to the life that you want to live. This is personal benchmarking. How do I make this structure resilient so we can mitigate the risks of the outside world or personal changes? Cash flow management, the pie cake. And then when and how do we iterate or have little conversations to re-examine everything, including our life, and identify little changes and risks and opportunities that we need to take action on? Because what we're doing is we're creating a process that will lead us to the tactics. And then through iteration, that's where the behavioral risk management happens. It's in these little conversations to remind ourselves what we said is important to us when we were comfortable, why we made the decisions we did, the strategy that led us to the tactics that we're worried about, say, at a particular moment. This is the process or the framework we use, and we try not to deviate from, because it helps me as an advisor make better decisions, help the client make better decisions, and it helps recenter the client. And you can create this kind of process too for yourself. We try to talk about it in the club in the masterclass. So the first thing, process. It always has to come back to these things because these are the important things. This is your personal benchmark that will help you mitigate some of the risks of this behavioral stuff. And so once we do that, when we get down to specific decisions, let's call, I want to buy the second house or the RV. Now we're getting into a very tactical decision. The first thing is we need to slow, we need to pause, because there's very few things we need to be that need a lot of speed in decision making in financial planning anyways, right? You're headed towards a wall. Yeah, you got to make a quick decision and turn the car. But in financial planning, if you have the process down right, you're not making decisions under time pressure, which could elevate these cognitive biases coming into play. So you have a decision. You want to buy the RV or the lake house. First, mind map everything you can think about of why you want to make the decision and what it might look like. What do you see yourself doing there? What does the place look like? Be as specific as possible. Who are you going to entertain there? What kind of things do you want to have in your lake house or your RV? How often will you use it? Just spitball everything you can think of. And then you come down to identify the decision. I want to buy a lake house. Okay. What will it take? It'll take a lake house would be, say, $200,000, $300,000. An RV, we'll call it $100,000. What does success look like? Well, success looks like if I buy the RV, my wife and I travel, or my husband and I travel 6 months a year, we get to visit the great ball of yarn in whatever state that is. And we get to tell each other fun stories. We get to meet interesting people. You get the idea. Just mark out what success looks like, and then mark out what failure looks like. We never use it. It's always broken. It's a time suck. It's a money suck. and could have invested those monies in vacations or other things. And then lastly, start to think about what are alternative ways to get what success looks like. Because buying a lake house, a couple $100,000, or buying an RV, we'll call it $100,000. What are alternative ways to get you the experiences that you really want to buy by purchasing those items? Obviously it could be renting an RV or a lake house. It could be high-end resorts. It could be camping, renting small cabins rather than driving around an RV, all sorts of things. It's limited by creativity. And then, so when you get to specific decisions, if you have the process of what's really important to you and you do that, when you get down to a tactical decision, you could replace this with go all to cash, buy an annuity. You can go through what's the decision? What will it take? What are some trade-offs? What does success look like? What does failure look like? And how might I do this a little bit more elegantly? This kind of structure, repeated consistently, can really help manage a lot of the behavior, the humanness that we all have. So hopefully that helps you. And this is sort of how I try to think through it. So hopefully it helps you too. And with that, let's go chat with BW in Coach's Corner. So here we are. It's the end of June, almost halfway through the year. And as we do every month at the end is bring on our head retirement coach in the Rock Retirement Club, Beach Walker. How you doing, BW?
Welcome to summer.
I had a conversation the other day, BW, with someone who actually had scheduled a fit meeting to become a client. It was clear that it wasn't a fit for either of us. And I had talked to him about the Rock Retirement Club. And he says, oh yeah, I hear you talk about that, but I don't really know what that is, which made me feel bad because I don't know why I don't talk about it as clearly as I might, but why don't you describe briefly what is the Rock Retirement Club? Maybe you can say it better than I.
Well, I describe it to people as a group of both pre-retirees and people just in retirement who are trying to figure out this retirement thing, both financially and non-financially.
That's pretty succinct. And we have conversations because we have meetups on all the topics we talk about where we go deeper, book studies and education and courses. It's a safe place to help make better retirement decisions, I guess is a good way of saying it.
That's right. I mean, all the education that's provided is wonderful, but the real strength of it, I think, is in the community that's developed and people can have these conversations. I can't tell you how many conversations we'll have. Let's say we're talking about an estate planning issue and people say, I wish I could have this conversation with my children or with my parents, but I can't. Yeah, and that's the beauty of the club, I think.
In a safe place, which we need nowadays. So you can check that out at rockretirementclub.com. So we're talking about behavioral finance and this concept that we aren't really rational people. Now, we're an attorney in your prior life. Do you think people are rational in their decision-making?
I think their decision-making is often distorted by their biases. And so decision-making, you can make a rational decision, but based on what facts? And we often deceive ourselves about what the facts are.
I think that's a really good way of saying it. I remember, and I think the perception of the facts, you have an overlay of emotion on top of that. And there's an art that's very refined in people knowing how to manipulate the emotion and the facts. It makes me think of a story. And I was an advisor and CNBC was hosting a seminar educational event, which seemed unusual. CNBC didn't do those types of things. So I went just to see what it was about. And there are 300-400 people in the room. You had a CNBC personality on stage, and then you had guests come up. Really what it was, hey, you can trade the market. And it's not as difficult as you think. And here's Johnny who made X amount in 28 days. And here's Sally who made X amount in 28 days. And here's them telling their story. And it was a lot of, they're not regulated. So the returns were quoted and they were outsized returns. It's sort of like we hear sometimes on Saturday morning finance radio. But the entire thing, and I was watching this and it was exciting. It was believable. And I'm a professional, but I could see, and it led to the end, which was the sale of, they happen to have a trading platform that gives you blue arrows and red arrows that basically will tell you what stocks to buy and sell. So all you have to do for $4,000 is to buy this trading system and it will pay for itself and you can just invest and not buy into the whole buy and hold thing.
And there's so many, from a behavioral finance standpoint, there's so many of the biases we hear about that comes into play there. The first one is FOMO, fear of missing out. You hear these testimonials, they're making all this money. What am I doing? Slinking along at 7% a year, So you want to go in. There's greed, one of the original sins. That's in there as well. I call that the bias of a good story, because I can read 2 articles by analysts that makes perfectly good cases for 2 opposite positions. And they're good stories. And we're all subject to that, right? Just recently, I've had this conversation with 2 people. One was, I'm going to go out and invest in cruise line stocks because they've been beaten down so far. There's nowhere they can go but up. Makes perfect sense, right? Then I had another conversation with another guy who said, I'm going to go short cruise line stocks because I think it's going to be a long time before people feel safe to cruise again. Again, perfectly understandable, superficially valid. What do you do with it?
Yeah, and intellectually both honest
Absolutely.
In terms of the analysis. I think of this when I see, we talked about this, I think last month in assumptions, extreme assumptions. There's this, what's that research firm that always talks about doom and gloom, and then you go watch the video and they never tell you what they do? Stanberry Research, I think it is.
Yeah.
The logic is always there. And then you overlay, whether it's fear, greed, or any of the other biases that we have, and it can be a toxic mix in our decision making.
I always say, well, that makes a lot of sense, but why do you think you know more about it than all the professionals who spend their livings and have all the analysts at their disposal? Why do you think you know more about it than them? Because you don't just have to know something that's right. You have to know something that others don't know.
But I think it comes down to the cognitive biases that we've been talking about all month. And where I think there's an opportunity, and I think with you being a retirement coach and what I do, and back to those market risk, specific risk, I think the number one risk that needs to be managed, whether you're accumulating assets, I personally think it's even more important in retirement, is behavioral risk, not beyond the investments in all areas of life.
Absolutely. Controlling your own emotions. That's where it comes in.
So
you act on every fear or every hot tip that you get. Can you control those emotions? Because you're going to have them. You're going to get greedy, or you're going to get fearful when you hear these things. Can you control them and not act on them? Maybe you need some help to do that.
And it's really, I think, the role of either a community, and this isn't a back-end sales pitch, but the Rock Retirement Club of safe people, or an advisor, or your spouse, is to have someone, or even a good buddy, is to have someone that is a good thinking partner that can say, you're not thinking about, you forgot about all this stuff over here. You might want to question your thinking.
That's right.
Why that I mentioned in our book study, because we're doing a book study inside the club on behavioral finance. And I mentioned in the book study, that's one thing I love about you, BW, is that you are a critical thinker, and it can be uncomfortable at times, but it's healthy.
I like to ask the tough questions.
And you generally are open to being asked the tough questions too, which is important. So how do you
stay open-minded? I learn things every day, don't you?
Try to. So how does, I think this behavioral risk of these cognitive biases, like market risk, they can't be eliminated, right? Unless we become Spock, and I don't want pointed ears. So how do we manage it? What would you say?
I think it's about making good decisions and having a good decision-making process. In other words, Nick Saban, Alabama football, people say, follow the process. Or Saban says, follow the process to his young players. If you follow the process, you put in the work, you'll get good results. And I think that applies here. You don't just listen to the latest good story. You have a process, you have your goals in mind, you know where you want to go, and then you won't be distracted by your emotions.
And it may slow you down to at least filter your emotions and your thoughts through the process to maybe moderate them or resolve them.
Yeah, maybe you need the old 24-hour rule or 48-hour rule before you make any purchases. You got to sleep on it a couple nights.
Yeah. And as much as I talk about being agile and adjusting and iterating, like Nick Saban, in your quote, he's had one process. He's refined it, but it's been one core process.
Absolutely.
And I think being agile and making changes is totally fine, but you have to have one process. That's the secret to a process. And a lot of times, well, I'm a long-term investor, and then I think I'm going to go trade stocks. I told you about the conversation I had, and this was with a client. Did I tell you about this conversation with airline stocks?
I don't recall.
I don't even know if I said it on the show, but this is a perfect example of you just need one process and you need to have faith in it so it can be the ballast to your emotion. So as a conversation right at the lows, right at the end of March, and they wanted out of the markets, 100% out. They had been long-term investors up until then, but they wanted 100% out. And the conversation was very emotionally charged on their end. It was not in a mean way. They were just afraid. And then, so we talked through that. And then literally right at the tail end of the conversation, do you think I should buy some airline stocks? And I didn't know how to hold both of those things in my head at the same time. I think that's who we are. I mean, not everybody's that extreme, but that's just what we do.
Fear and greed, right? You saw both sides of it.
Yeah, I think so. Well, we've had great conversation about this in the club, and hopefully this was helpful for everybody. Any last words for us? I know you've been talking about grandparenting in the club. Now,
yes.
Tell me a little bit about that. How do you be a good grandparent?
Well, first of all, it's one of the best parts of being retired, right? You've got time to build that relationship with your grandchildren. And really, the grandparent-grandchild relationship is one like just no other, because you don't have to parent. And in fact, it's good advice not to parent. You want to let the parents be the parents. You want to be the grandparent. You want to be that confident, the one they feel safe with, the one they're comfortable with. And then you can just have fun and be silly. So that's what we're talking about in the club, how to be a good grandparent. Sometimes grandparents need to be parents if the parent's no longer in the picture, unable to do the parenting, and that's a different story. But we're spending most of our time just talking about the fun parts of being a grandparent and how to really have a great effect on your grandchildren's lives. So we're having fun with that.
Now, I remember growing up, my mom was single for most of the time, and our grandparents were, on her side, were very involved in our life. And I would imagine as a grandparent, because I'm not one, and I better not be anytime soon, is parents are busy being parents, right? And I could see my role as a grandparent as sort of being the fun.
Absolutely.
But also the mentor, because I'm going to be able to say things that their parents would say, and they're not going to hear it because it's the parents, right? To sort of be that outside voice to, sort of whisper in the ear. Yeah, the coach is yelling at you. Don't worry about that. But this is really what they want that you do, and help interpret it a little bit. I would imagine that's an important role.
It's such a special relationship. When I think back, my parents were both very active in my life, but the stories I remember, 80% of them have to do with times I spent with my grandparents. Those lasted, and they're in my memory all the time. And so, yeah, and there are lots of roles that grandparents should play. But one of them's not parenting. You don't have to be the disciplinarian. You don't have to set rules. You can just be fun Roger.
I like
Grandpa Roger.
Yeah, I have to figure out everybody has weird names for themselves as grandparents.
That's one of the things we're talking about, because a lot of people you have to pick that name, and you've got to get it early because you've got competing grandparents perhaps that are fighting for that name. So you want to come up with yours, and you want to get it established early that you have the right to that name. What are you thinking about?
Well, on my dad's side, my dad wasn't, but my dad's parents were involved in our life. I don't like theirs. They were Nag Nag and Man Man.
Nag Nag and Man Man.
Yeah.
I've never heard those.
I don't know. What about you?
One set were Papaw and Mamaw. The other was just Grandma and their first name. Grandma Ruby.
Maybe I'll just have them call me Ram.
Oh, going to do some marketing. I like that, Roger.
Everything's retirement answer, man. Ram.
One of my friends just became a grandfather, and he's going with Cappy, although everyone's rejecting it. So he's having a hard time making that stick.
Captain would be good. I would want something sort of regal. Captain. Hey, Captain. Hey, Cap. Oh, I like that. I'll have to buy the URL. All right, buddy. I appreciate you coming on here, obviously, but in the club, we have so much fun. So thank you.
Good to talk to you. Talk to you next month.
All right, everybody. Let's go set a SMART sprint.
On your marks, get set.
And we're off to set a little baby step that you can take over the next 7 days to live a better life and rock retirement. So in the next 7 days, here's what I suggest you do. The next decision of consequence that you make, go through that decision exercise, even if it's just pausing and defining what success and failure looks like. So the next decision of consequence, maybe you do it with a decision that's not consequential. I want to go get ice cream. You could do this exercise to start to learn how to say, okay, if I go get ice cream, it's going to taste sweet. I'm going to be sitting outside looking at my spouse. I'm going to maybe meet somebody. And then the downside could be what? I get a bellyache. I put on a pound. I have regret. You get the point. So in the next 7 days, figure out how to just practice this decision framework. So when the bigger decisions come, you'll start to have that habit. So speaking about intentionality, I got something the other day and I was so excited about it. So in my office, I have a calendar, and this is not just any calendar. And I've talked about this before. It's 3 feet wide, 6 feet long, and contains the entire year, January through February, or through February, January through December. So here's what I did. The calendar I use is at neuyear.net, N-E-U year.net. I'm actually going to see if they can do a Retirement Answer Man edition of the calendar, because they've done that. And they just came out with 2021. So I have the second half of 2020 and all of 2021 going about 8-9 feet across my wall. So we can plan out the important days first, vacations, personal time, some sabbatical time, and then content for the show. And then we map out monthly themes and all of that. So I'm excited about that. If you're an Uber planner, you might enjoy that at neuyear.net, N-E-U year.net. With that, we're ending the first half of 2020. And my wish for you is that you have a wonderful second half, maybe a calmer second half of 2020. And we'll talk to you next week when we start to dive into a whole month of estate planning. You be well, okay? Hey, it's time for that all-important disclaimer. We so appreciate you listening to the show and love your questions and love the teaching that we're able to provide here. And actually, it helps us too. But remember, you're not our clients.
Not love it if you took advice from us on the show.
We would not love it if you took advice from us on the show. Realize this is helpful in education. Talk to your legal advisor, your tax advisor, or your financial advisor before you make any decisions.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.